But first and foremost, I want to hear a success story of the week from each of you guys. What worked well this last week with your clients? Melvin, starting with you. What problem was identified? What solution was provided?
I put me on the spot, Jake.
I did. Just so that you know, I might ask this every week.
From the prior week?
From the prior week or something in the very immediate past that maybe, wasn't just a week ago, but something that stood out as a problem that you identified for a client and a solution that was given.
I don't want to make anything up.
No.
Hey, Melvin's face is about to fall off. Give him a break. He didn't even think the guy's got a toothy.
Melvin, while you're thinking about it, let's put the Newtons on the spot. They perform really well under pressure.
Yeah. So one thing we've done that has been pretty cool and definitely valuable is the DSTs with Brett and Jen. So they had a joint property. We did a bunch of stuff to like lower the cost, lower the mortgage, increase the cost basis, so we could actually use the deferred sales trust on this transaction. And now they each have just under $200,000 each into this account that they were able to defer.
And had about 8 days to pull it off.
Yeah. So we were able to accomplish that for them. And then we just had meetings with both of them where we're able to position ourselves as obviously significantly different than what they're used to from a financial advisor standpoint, right? So Brett already has an advisor, but
with a lot of letters.
Yeah, with a lot of letters behind his name, does cool things. I don't know. But
he doesn't do cool things.
He doesn't do cool things, but it was cool because what he said, what he's wanted from a CPA, from an advisor, was basically exactly what we were telling him, is that he wants somebody who is proactively coming up with a tax mitigation game plan, which, no offense, Melvin, but like CPAs don't really do that. Like, unless they have their tax planning specific and they're like, hey, I'm going to take 6 months before we have the end of the year and do some planning around some of the tools that we utilize. They don't really do that. So we're like, Brett, that is literally our exact job. Kelly's awesome, but that's our job, is to bring those solutions to you and then work with Kelly to implement them. So yeah, we're going to look at, he hasn't agreed to it yet, but he's definitely open to the $2,500 planning fee. And then we'll be managing the $200,000, and then he'll have another $200,000 coming in when his Des Moines deal closes also. So that one's been pretty cool. And then Jen.
Well, so real quick on the Brett one. So what I thought was cool is, like, just a year ago, we really wouldn't have had anything to offer him, right? There'd be no reason to even consider us. Or this time we got in with a DST, right? A very specific thing. But then we went over, hey, here's the tax planning, here's the tax strategies, here's all these cool things. And we just go very high level, right? Just to get him enticed on all these things we can do. And he'd heard of virtually none of them, right? And so it's, hey, here's really what we do. This is a product, but what we do is we look at everything comprehensively and we decide, hey, how should we implement one of these or two of these, or this year versus next year versus 5 years versus 10 years. Like, we build out this entire thing, and we're talking about strategies that he hadn't heard of, where he's been with this guy for 8 to 10 years. The guy is a successful day job and real estate person, has a significant net worth, and he'd not heard of any of these. And he said, well, my guy, he pretty much like puts me into the right asset allocation, and he'll rebalance the portfolio, but it's all pretty cookie cutter. And so we had the discussion around it. That's why we moved, right? Is because we couldn't have our clients outgrow us. And that's a lot of times what happens, right? Is where you were at 10 years ago, that was probably all perfectly fine. But where you're at today, you may have outgrown your guy, right? And so being able to have that discussion.
How long have you guys known Brett? Just in casual passing, from the very beginning, how long have you known Brett?
6 weeks.
Maybe 6 weeks. Talked to him like three times.
And as you mentioned, a year ago, you wouldn't have been able to have this conversation.
No.
The last 6 weeks, something became a differentiating factor from a year ago, in the sense that, hey, now it doesn't matter your current people, your current advisors, all the letters behind their name. Now it's all about the solutions to their problems, right?
Yeah, absolutely. And it's all, most of the solutions to the problems of people that we're trying to work with is around taxes. and advisors don't understand taxes. They don't plan for taxes in the way that we do here. So that, and everybody wants it. I mean, if you talk to anyone, if they're making money, one of their biggest concerns is how do I keep as much of this as possible? And it's just not being addressed in the advisor space like we do here. And then they definitely don't have as many strategies as what we have here.
And then one of the things that was key for us that we always make sure we do is we got introduced to do the DST on something specific, right? Then we said, hey, that's great. Let's see if this makes sense. But so we talked to them about it. And once they were like, hey, I think we want to look at this, we said, well, that's great, but we got to meet with you individually and really find about you, your situation, your goals, where you're at currently, what have you done thus far? And so we did each of them, we did a full fact finder with them, right? And so that then positioned us as like, hey, we're not just selling you a product either. We got to know that this is the right fit for your overall situation, which then led us into executing it because we all agreed it made sense in their plan, but then positioned us as, hey, we're not just selling you a DST, we're actually looking at building a comprehensive plan for you, even though on the surface, neither of them would really have interest in going through that process. But just making sure that, hey, if you want to utilize this, we have to, do this process.
Yeah, and you really do, because you don't want to recommend something without understanding their situation at all. I mean,
Exactly.
Yeah.
So I like the fact that we're providing solutions that in this particular circumstance, you were able to provide a deferral of an otherwise capital gains tax situation without using a 1031. And you were able to allow him to reinvest it at his will rather than the arbitrary allotment of so many days after and everything else. So, and as you mentioned, sure, we did a deferred sales trust that was a piece in an overall plan that now you're going to be creating for him, a financial plan going forward, how to be more efficient from taxes, how to not only analyze cash flow, but tax flow, and to acknowledge that rate of return sometimes comes from tax savings and not only just, the investment ups and downs.
Yeah, we concur.
we agree.
Very good. Wonderful. Okay, well, I'm going to talk about a restricted property trust really fast because I've had a few people ask for that. And this is being recorded so that we can, utilize this in the future, this particular training. What we have today, let's talk about various retirement plans. Has anyone here ever done a pension for a client before?
Cash balance plan. Those
Cash balance is the number one. Cash balance is the number one most commonly used defined benefit plan or pension.
Mm-hmm.
Very good. Now, what was that like? Can you give me a few details? Was it for a owner operator, one person employee, business, or was it for a business that had multiple employees?
Husband, wife. So there's two owners and that's it.
So two owners, and what were their annual contributions?
So it ranged. So we kind of basically used it. We stayed above the minimum and we didn't really go up to the maximum. So for this past year, I think it was literally anywhere from like 20,000 to 200,000
Okay.
that you put in to the cash balance plan.
So there's a little bit with the cash balance, which again is perhaps the most flexible out of everyone, and it's the easiest and the least expensive to set up. So anywhere between 20 and 200,000. And how many years did you project that they would contribute?
So it was my understanding it's at least 3, and we're planning on just using it until, if there's something better to utilize, then we might, stop the cash balance plan, roll it into an IRA, and then potentially look at maybe doing a restricted property trust, an 831B, depending on what their company needs at that time.
Okay. So a cash
Planning on at least 3 years, but likely indefinitely, unless there's a better option.
Well, let's talk a little bit about the cash balance plan, the benefits, the pros, the cons, and what other aspects are out there, why you're thinking about maybe a restricted property trust, why you're thinking of an 831B. So with this particular client, they have the flexibility between 20 and 200,000 every year into their cash balance plan. The cash balance plan is a qualified retirement plan that obviously, there are certain allowances at age 55 that they can get money out, right? But normally, normal retirement age per the IRS guidelines, 59 and a half. Plus they have required minimum distributions at 72, right? Now, it is a phenomenal tool for deferring income now and putting money away. And with this particular cash balance plan, you have the flexibility of between 20,000 and 200,000. You must participate at least 3 years, right? Otherwise it kind of blows up internally. Why would you consider doing something else? Well, let's talk about the fees. Are you very familiar with what your client pays in TPA expenses and ongoing fees for this cash balance plan?
Not super familiar. It literally is very cheap, but we're going to be switching to a different TPA because TRA, the Retirement Advantage. This is a recorded line, and I want everyone here to know that they're pretty terrible. So, yeah, we're going to switch it, but there's issues that TRA has to resolve, not with the cash balance plan, with another piece of it. So once that's done, then we'll switch it and it'll be more expensive. I think it's like for someone who actually knows what they're doing, I think it's $2 or $3 grand for this type of cash balance plan.
Annual fees or whatever.
Yeah.
Okay.
Which is
that's okay. I mean, that's typical. That's common.
Mm-hmm.
I've seen as much as $500 a month in maintenance, but that's usually when you get really fancy and you have other things besides marketable securities inside of your cash balance plan. And that's fine. That is one product, and it has its place, and it has its appropriate time and everything else. Occasionally, people choose different types of products. Oftentimes, when they have employees and they want to carve out a piece just for the owners, and they actually want to discriminate. Like maybe they already do a 401k, or maybe they already have a cash balance plan, and they want to do something more for the owners, right?
Mm-hmm.
In those scenarios where they're already participating in a lot of other, benefit plans for employees, and they would like to take some of the extra earnings that they are habitually having year after year, instead of just giving a bonus to the owners based on performance, because a lot of these owners are owner operators, right? Instead of just giving a taxable bonus that might be subject to, the payroll taxes, might be subject to, all these other things, they could be participating in a restricted property trust, which is a retirement plan specifically for owners of companies. Now, these are not sole proprietors, but these are owners of companies that file as a partnership, file as an S corp, file as a C corp. Okay. A restricted property trust, just like a pension, is kind of considered its own entity, right? So a pension or a defined benefit plan, a cash balance plan, has an annual tax return. A 401k has Form 5500, right? These are an annual tax return because it has its own existence out there. And you have to file, not necessarily for tax purposes for the plan itself, but for all the participants, there needs to be a corresponding filing that matches up with their deduction or their Roth contribution, depending on, if they're doing normal offset of income, so they get that deferral. So a restricted property trust, I oftentimes compare it to a defined benefit plan or a cash balance plan because there's a lot of similarities. Let's just talk about cost. A restricted property trust costs more in the first year, costs more to set up because there's that initial fee for the attorney to set up the trust, which is a little bit different than setting up a cash balance plan. So to set up a cash balance plan can be less expensive in the first year. But then, as you mentioned, $2 to $3 grand or sometimes more ongoing in a defined benefit plan, a cash balance plan, in annual maintenance fees. The restricted property trust typically is between $500 and $1,000. And that's just based on the number of owner participants in the restricted property trust. And so it's more expensive up front, less expensive over time. And that's just talking about cost.
And Jake, you can fully discriminate, right? So you can pick, hey, I want this owner, or this owner gets a restricted property trust. This one does as well. This owner doesn't. Because my understanding, cash balance plan, you have flexibility, but there needs to be participation by pretty much most employees on some level.
So let's go over this real fast. Let's go over qualified retirement plans. Qualified retirement plans, cash balance included. You cannot discriminate, and there are annual testing requirements that GPA has to do to show that based on payroll and everything else that we're not discriminating on in regards to individuals' contributions. All right. And the more diverse the workforce is, sometimes the more stringent those test requirements become. Meaning, if you've got people who make $200,000-300,000, you've got people who make $10,000 a year. There's going to be some very avid testing requirements, which also increase the expense of the plan.
Yeah.
You cannot discriminate within a qualified retirement plan. Now, the non-qualified retirement plans, your executive bonus plans, your split dollar plans, some of these other things, you can reward employees and or owners up to a certain extent. And those being non-qualified oftentimes are taxable in the year of. So they're taxable in the year of. They usually have some form of life insurance, cash value life insurance plan within this golden handcuffs benefits package that is put together. And it can be for employees and on certain occasions, owners as well. Now, the restricted property trust is not for employees, though it might be compared to a non-qualified retirement plan, could be compared to a life insurance retirement plan, because there is a life insurance aspect to it. However, rather than being taxable, fully taxable to the employee in the year of, as many non-qualified retirement plans are, this is fully deductible to the company in the year of, and only partially taxable to the owner-only employee, meaning this is an owner-only retirement plan. So in the way that you say that you can discriminate, not only can you discriminate, it cannot be allowed that anybody else participate except for owners. And so depending on your need, if you're trying to reward highly compensated employees, a non-qualified retirement plan like an executive bonus plan would be suitable. If it's kind of like an owner type highly compensated employee, a split dollar plan might be more applicable. If it's something more along the lines of, hey, I want everybody to have this benefit because we're doing very, very well and I want to retain top talent, then let's offer a cash balance plan. So let's roll back to the restricted property trust. Owner only retirement plan. More expensive to set up in the first year, less expensive over time to maintain. An individual must be healthy enough to qualify for a life insurance policy. Essentially, it's a retirement plan that the asset inside of the retirement plan is a whole life insurance policy through a mutual company that has certain guarantees associated with it. And in addition to that, has a high dividend, one of the higher dividend performing life insurance companies in the industry. The TPA decides every year which company that's going to be. Historically, over the last several years, that company has been Penn Mutual. How does this work? How does it put together? There's a process, and the process includes being able to consult with the client and making sure that they're not trying to eat their dessert before they have their entree in front of them, so to speak. So what do I mean by that? Melvin, if you and I go to dinner somewhere, and let's say that we have a 7-course meal, when do they bring out the dessert?
At the end.
At the end. And how does it compare in size to everything else that you just ate in that 7-course meal?
Smaller.
It's smaller. It's typically the smallest thing. I mean, you might compare it to like the Coca-Cola or whatever you're drinking that night, right? Similar in something that the Newtons brought up here in the beginning was, hey, not only are we providing one transactional service, but we need to take a look at the entire financial global view of what the client's doing to make sure that not only does this one transactional service make sense, but in the overall large scheme of things, we're doing what's in the best service to the client. So with that being said, we don't like anyone to be pushing products, right? We like to provide advice to a client based on what their needs are. And you could say that, hey, an individual client might qualify for $1 million into a restricted property trust, and they might qualify. They might have the appropriate net worth. They might have the appropriate liquidity, everything else. But you need to take an overall look at all of their other assets, because literally the restricted property trust, as an additional thing that can be done for the owner, they typically should have some other things going on. They should have some other assets out there. They should have some other things that are liquid. Oftentimes, a lot of these clients also have an 831B. They also have, large savings or liquid investments in marketable securities. And why is all of that important? To qualify for this type of strategy, an individual, instead of just 3 years, as you mentioned, with the cash balance plan, they must participate at least 5 years. So the requirement is a little bit higher. It's a little bit more expensive to set up. The requirement of how long they participate is a little bit higher. They make a fully deductible contribution from their company. Let's say it's an S corp, fully deductible to the S corp into a restricted property trust. That trust then takes those funds and buys a life insurance policy, a whole life insurance policy on the individual owner. Part of that then is phantom income to the owner, similar to a non-qualified deferred compensation plan like a executive bonus plan. Except the difference here is an executive bonus plan would typically be fully taxable to an employee, a highly compensated employee, whereas the restricted property trust contribution is only taxable to the extent of the death benefit of the whole life insurance policy. The death benefit that the individual still has control over who receives that death benefit. They can designate their own beneficiary. Now, this is a company asset. This is a company retirement plan, but the individual can control who receives the death benefit. And because of that economic benefit, should the individual die during the funding phase of this retirement plan, should the individual die during the funding phase of this retirement plan, there's a very large death benefit that is paid out to their beneficiaries. And they have to pay a little bit of income tax, phantom income, because the money's going into the retirement plan, not going to the employee. They have to pay a little bit of phantom income, sometimes up to 30% or even 40% of the amount that was fully deducted by the company, the S Corp. All right. So instead of having, let's say that we use, let's actually look at an example so that we can illustrate this and make this all make sense. All right. Can everybody see this?
Hey, Jake, you said for these restricted property trusts, they're owner only, right? So you have to be an owner in the company.
That is correct. This plan,
can you be a minority owner? Like, can you own 1% of the company and then still have restricted property trust for yourself?
that is correct.
Okay.
There are other eligibility requirements. They want to see that you're a part owner in a company, that you have a company that is eligible, that the company is doing sufficiently well, that per participant, there's around 600,000 of taxable income. And that can be a combination of W-2 or salary and distributions like K-1 distributions, etc. But they want to see, if it's a C corporation, they're a partial owner of a C corporation, and there's 3 owners, they want to see that there's the 600,000 times 3 owners if all 3 want to participate. Now, if you have 3 owners, but only 2 want to participate, and there's only, $1.2 million in revenue, that's okay. 2 of them can participate. There is a 600,000 rule of thumb limitation. Now, does that mean that that's a hard and fast rule? Not necessarily. We can look at the other income that some of these individuals have so that at the end of the day, coming to them, they have over 600,000. Part of that plays into, as a rule of thumb, the overall net worth of the individual and the future earning ability based on the current year's income, that they'll be able to sustain this additional retirement plan ongoing, in addition to all the other expenses. Okay.
For a husband and wife, would you be able to do one, but have their assets pooled or basically their income pooled if they're joint owners in the company?
On a case-by-case basis, something
Okay.
like that is possible, yes.
Okay.
So we just have to review that, and the ultimate say, Kenton Crabb, who is the TPA, he has the ultimate say of whether it works or it does not.
Okay.
Again, a lot of this also goes to the validity of a company, the risk of a company taking on a retirement plan and their ability to pay for it in the future. I have found that individuals that at least meet these minimum requirements are more of a sure thing. They have a little bit more of a longevity in front of them to where there's less risk of them having difficulty paying this ongoing.
Yeah.
All right. So minimum contribution, unlike a cash balance plan, this has a minimum contribution of $50,000. So a little bit more expensive in the beginning. It's an owner-only plan, and you have to be doing it at least 5 years, and the minimum is $50,000 annually. All right. So again, all of these are more reasons why this becomes the dessert at the dinner table and not the entree, right? So barrier to entry is a little bit high, but those people who are able to participate in it, they end up with not only a deferral or a deduction of the income that they put in, but at some future date, they receive a fully tax-free, after certain taxes are paid throughout, they receive a fully tax-free death benefit that their company was able to efficiently optimize some of the otherwise taxable situation they would have had they not done this strategy. So in this circumstance, we have an individual with an effective 45% tax rate. Another important feature behind the income requirement is that they're in a high enough tax bracket that this becomes a no-brainer that they should do, that the tax pain is significant enough that this makes perfect sense for them to do. If their tax bracket was in the 15th percentile, it may not make sense. All right.
Federal and state then?
That is federal and state.
Okay. So there's just top brackets. Okay.
Yeah. So, I mean, if somebody's in the state of California, we're 37% plus the state of California, 13.3. You can see how that could be even higher and make even more sense. This is based on a real life individual. We've omitted her name, but let's go through this. Age 46, 50,000 for 10 years. Again, the requirement is at least 5, but you can see that at the end of 10 years, she has more in cash accumulation in her whole life insurance policy, which with this particular company, they actually perform as illustrated, which is rare amongst insurance companies. There is an annual participation in some of this income. Let's say that it's 30% is included in a phantom income in our tax return, right? She individually receives some of that 50,000 that is fully deducted by the company. She has to pay taxes on some of that. And then here at the very end, there's a transfer tax. There are certain states such as Connecticut, New Hampshire, California, and others that even if you move money from like an LLC that you're the sole proprietor of to your name, normally what would just be a quick claim deed, they tax you on the transfer of any assets. All right. So universally, to avoid all issues and concerns that might occur both federally and state, there's an upfront, once we exit the trust and dissolve it, there's a tax to move this asset over, and that allows for the death benefit to remain tax-free and the cash value. People have the ability to receive the loans from their cash value of their policy on a tax-free basis. And this is just an illustration of this individual who decided that they wanted to project retirement age at 61 or 60, and then at 61 taking income, right? And it shows 20 years of income. It shows that the individual spent $500,000 that was fully deducted by the company, invested that $500,000 through this strategy, was able to pull out $895,000 tax-free. And I say tax-free, there was $113,000 of taxes paid to get it out of the trust. If I come up here to this little corner here in the bottom left of this flow chart, we can see that the tax rate plan participation versus what she would have normally paid on that income, should she have only received it as like a bonus at the end of the year or something of that nature, which we talked to a lot of people who are receiving annual bonuses based on performances that year after year after year, they're receiving very similar, it's steadily growing. This is a perfect strategy for those types of individuals, those owner-operator individuals. Whereas here, effective tax rate of what she pays in phantom income every year, plus the $113,000 at the end of 10 years to liquidate the trust and get the policy out and own it personally, she would have otherwise paid 45% of that in taxes. And you can see that the difference, the arbitrage between what she would have paid in 45% versus the 15% that she is projected to pay through this strategy is rather substantial. She has almost a 30% tax savings by participating with the funds in this restricted property trust. And so you can see again why individuals who have these minimum income thresholds are in the highest tax brackets, and this becomes an almost no-brainer for them. Now, again, this is not their entree at the dinner table. This is their dessert. This is what else can they do to win in the margins type of strategy. It does require a minimum of 5 years, and it does oftentimes make more sense if they participate 8, 9, 10 years or more. So again, if I just review the immediate tax efficiency of utilizing this strategy, 30% savings on tax, or you could call that a rate of return based on tax savings of roughly $150,000 of tax savings, an annual deduction of $50,000 to the company. Based on 83B of the IRS code, they do include $15,000 of that yearly in their income. And if we look at the flow chart here on the right, for the actual mechanics of how the plan works, I'll make this a little bit smaller so it fits on the screen. You have your business entity that makes the contribution to the restricted property trust. The business entity of the $50,000 contribution, $15,000 of it is included as phantom income on the individual's tax return, the individual owner. There is a death benefit that they are allowed to provide and choose who the beneficiary of that death benefit is associated to should they pass away during the funding period. Of course, after this is fully funded, there is an associated death benefit that continues with the policy even when it's transferred to the owner of the company. The participant recognizes some of that income because of the economic benefit at the end of the funding period. So should it be 10 years that they choose to fund this, in this example, as illustrated, there would be the trust that would pay $113,000, not the individual, but the trust would pay $113,000 in transfer tax to then transfer the whole life policy to the individual. We have here, as illustrated, the non-taxable disbursements to the participant of $895,000, almost $900,000 of tax-free death benefit to the beneficiary, and the non-taxable exchange to other insurance products. So what does that mean? Brian and Brendan, you've been helping an individual review the pros and cons of doing a 1031 in real estate versus a deferred sales trust, things of that nature. There is very similar to the same tax code of a 1031. There's what's called a 1035. After the policy is out of the retirement plan and owned individually by that person, there is an additional benefit here that should the individual's risk tolerance be appropriate enough, they could roll over this whole life policy that has a lot of cash value into it. If they're still healthy and can still pass an insurance exam, they could roll this over into an index universal life policy or a variable life policy, depending on the year that this happens, their health, and what else is out there in the market if something better is available, which we're all very familiar with. The market of life insurance, occasionally they adjust the mortality tables. People live longer, they get better rates, and illustrations end up being providing a better outcome. And occasionally it makes sense to roll one policy into another.
Hey, Jake, so could we 1035, like say into premium finance on the back end or something like that?
Not during the funding period where they're getting a
No, but like
Yeah,
on the back end, right?
yeah,
So
it's
after
after
the
the
taxes
transfer.
are paid, the transfer happens. Because I assume once you're transferring and paying that tax from the trust, essentially the trust is no longer, now it's just an individual owns this policy.
Yep, it becomes just like any other life insurance policy that an individual owns.
Yeah. So
And
then we got 1035, like with Jeff Fain and his group, right? Where he said, yeah, 1035s are fine. You do that all the time.
Yep. So this becomes just like any other policy that you can do what you would normally do with any other policy, any other whole life policy, cash-centric policy. Should you wish to roll it over into anything else that is eligible to receive a rollover, you are able to do that at that time. Again, with the disclosure that the client's health has to be suitable.
Stuff to
Yeah,
qualify. Yeah.
definitely.
Absolutely. So this can be a funding strategy that the individuals utilize to save a lot of money on taxes while during the funding period, and they're putting money away that is fully deductible to their company. They will be incurring a little bit of tax based on their age, their health, and a few other factors, whether that number is 30, 40%, what have you. Annually, they'll be incurring a little bit of tax on that as income because they are able to designate who the death benefit would go to should they pass away prematurely, right? And so they're able to get this full deduction, participate a little bit with partial income of this benefit, and then the trust itself, not the individual, so it doesn't affect the individual tax rate or anything of that nature. The trust itself pays a transfer tax to transfer the asset to the client. Once it's out of the trust, they can treat it like any other cash value life insurance policy that's out there.
And Jake, you said the trust pays it. So are the funds that are being used to pay that transfer tax coming from the life insurance policy?
Yes.
Does it have to work that way? Like if they have a taxable account, could they use that instead to pay it so they could keep more in their life insurance policy?
So you could transfer it back in after, but it does need to be paid by the trust and not the individual because it's the plan. It's the plan. Think of it as a retirement plan. Again,
Yeah.
a lot of people get stuck thinking of other life insurance strategies, but this is a legitimate retirement plan and it functions like a retirement plan. The expenses of the plan need to be paid out of the trust assets.
Okay. Yeah. And you can't fund the trust with outside assets. Like it would have to be coming from the life insurance policy.
So you would not be able to pay the retirement plan expenses out of, specifically to these tax expenses. Yes, the plan itself would have to pay those. But think of it this way. It's coming out of the life insurance policy. And how long do you have to wait to put money back in that you've borrowed from a life insurance policy? There's really no restriction.
Yeah.
If I borrowed from it today, I could put it back in tomorrow. And so the trust pays it, the trust entity, right, pulls money from its asset, it pays that tax, and then once that asset is then transferred to the owner can put that money back in.
Oh, okay. Yeah,
It
that would be how you do it. If you wanted to not have any of if you wanted to not take any distributions, that makes sense.
But then again, anything after the policy is transferred to the individual, any future contributions, which are allowed, but any future contributions obviously are not deductible because they're not sent to a legitimate retirement plan.
Yeah, because then it just works like an
Individual life
individual life
policy.
insurance policy.
Exactly.
Okay.
So then like with our client, right, where they'd be doing it for themselves, right? Those, husband, wife, business owner, essentially conceptually it'd be, hey, we're getting a $50,000 deduction, but we're showing 15,000 of it as income. So it just, that conceptually is kind of what you'd be doing, not.
Yep. You'd show the deduction from the company, and it might be a pass-through entity like an S corp or a partnership, right?
Yeah.
Yep.
And that's fine. The company gets the deduction, then they get a K1 to show 15,000 income that comes to them.
Okay.
Yeah, which they would have had made all that money anyway, so they're still just getting additional deduction.
But by doing the strategy, instead of showing 50,000 of income, they're showing 15, right?
Yeah.
And at the end, the policy, the internal growth of the dividend and everything else, I mean, this is substantially better than just putting money in the bank after taxes. In fact, there's a corresponding chart that shows, based on a 9% return in the market, how this even outperforms that based on what it's able to do on a tax-free basis, right?
Yeah, Jake, can you pull that that slide thing up again? Yeah, I just want to see what the market one looks like. If you could go over that one.
So essentially they'd be getting a $35,000 deduction is really what it would be equivalent to.
Well, if you're talking net, right? But you've got your business in there, you've got their personal lives in there. You got to make sure you're allocating things correctly, right?
Yeah.
So here we have, under this cash flow chart, right? In the first year, well, they put away 50 and they only have on the balance sheet an asset of 14 grand, but they have a death benefit of 2 million. So they're accomplishing some business purposes for having this life insurance policy that is an business owner only policy, right? On the counterpart of this, if they invested this money in the market rather than putting it into this type of an asset, if they just put it in marketable securities or something of that nature, it might go up maybe $1,500, $1,600, $1,700, right? And so instead of having cash value of 14, you would have cash value of 35, but no corresponding death benefit, which again, there's a reason why this is the dessert at the dinner table, right? Ideally, they're doing other things already to provide liquidity. Ideally, they already have a corporate investment account. Ideally, they're already doing an 831B strategy. Ideally, they already have hard and liquid assets in other areas, right? Obviously, as years go by, we end up here in year 5 with almost as much money as they would have invested in the market. We have almost as much money and we have an over $2 million death benefit. So if they hold this for no more than 5 years, based on the tax favored status of this asset and the fully taxable status of this asset, you have an additional death benefit bought and paid for. So you can see that if they only hold this for the minimum number of years required, they are already matching or nearly matching in cash value and exceeding greatly in overall benefit should something happen to the owner. Then, of course, if they hold it the 10 years, it's a little bit sweeter where they have more money in than they put in, right? Which outruns and out-improves a market performance based on that 9% rate of return, based on their investment of after-tax dollars. Now, if she had planned on retiring at 65 rather than at 60, and if she planned on keeping her business going longer, she could show additional years of funding. And the more years that you fund this, and you allow the dividends from the mutual whole life insurance company to continue to supercharge the policy, the better and better that it looks.
Jake, along the lines though, would you, in your opinion, rather do that than if they're still healthy, switch it over if they could do premium finance or an IUL and 1035 it over?
It depends what the client's global goals are.
Yeah.
So I have clients that do this because they get a deduction from their company. And then personally, because their net worth is high enough, they do a premium finance policy. Again, because the premium finance is also kind of more of a personal estate planning type strategy.
Mm-hmm.
Now, should their business go away and they no longer need the deduction and they have rolled this asset out of the trust, they've paid the transfer tax, and it goes to them personally, and at that time, it makes sense to consolidate some of their assets, then it might make sense to do a 1035 with this personally owned whole life policy that is cash rich into a premium finance type strategy. But each strategy should hold its own merit, meaning Does it make sense to do premium finance? Well, it might. And does it make sense to do restricted property trust? Well, it might. People oftentimes buy life insurance as often as they buy or sell homes, which, depending on the state, is between 7 and 13 times. So as a person's needs change, they get more death benefit, or they decide to get a cash value policy, or they decide to get policies on their spouse or significant other, or they get policies on their kids, right? So there's the purchase of life insurance isn't always done for asset needs or for asset protection. There's a lot of different reasons for doing this. This is one out of many, in the sense that this is part of a retirement plan.
Yeah. Did you already say that transfer taxes is 20% or roughly that?
So you're doing these numbers you're doing the calculation based on some of these numbers without including the illustration and the 5 to 6% dividend and some of these other things. So it would appear to be 20% of the overall assets, but we're not including the growth internal of the policy and the true asset size. So instead of the 500,000 contributed, do the tax based on this cash value number.
Is it 460 or 547? 547.
Sorry, it would be the 547, because this is net after that's calculated.
And Jake, is 50,000 just a minimum? Is that just this example?
50,000 is the minimum. You can go anywhere above 50,000.
Yeah.
Now the 50,000, if there's two owners and you do it in the life of both owners, like the husband and wife scenario you're talking about, you can do 25,000 on each person, as long as the trust receives a minimum of 50,000.
Would they just share a trust then?
Correct. This is one trust, and there can be as many owners or participants inside of this retirement plan for owners only as there are owners. So usually again, this is a company retirement plan for the owners. You identify an eligible company, and then all of those owners are able to participate.
Yeah.
All right. Now we have a question in the group. We have somebody asking what a premium finance policy is and what is a 1035. Brennan, do you want to take that?
Yeah, so 1035 is like what Jake was talking about with 1031s. People are pretty familiar with them. You can defer appreciated buildings. If you have a rental property, you can use a 1031, roll it into a new property. So 1035s are similar, but with life insurance. So you can take a life insurance asset, do a 1035 and roll it into a different life insurance asset without having to pay taxes on that transaction.
So we're talking about appreciated assets or assets that have grown. Usually there's a capital gains tax, or there's some kind of tax based on that growth, right? And we're just rolling it over. Very commonly, as you mentioned, Brendan, in real estate, people do this a lot of times. They sell one property, roll over the basis, roll over the accumulation or the growth, and any of the other aspects of it. They roll it over into the next property that they buy of like kind. And very similar to 1031, a 1035 is just the same thing, but with life insurance, where you're taking the basis, which in a life insurance policy, the most expensive years that help you incur basis are the first 5 years. That's when the mortality expenses are taken out, commissions to insurance agents are taken out, underwriting fees and expenses are taken out, mortality expenses are the greatest. That's when all of the most expensive years of a life insurance policy happen. Now, if you can roll that basis over into a new policy, you're saving yourself a lot of expenses, as well as the offset to future gains should you do something that causes a life insurance policy to be taxable, is incredibly important that you're able to roll that over.
Yep. And I just realized that it would be probably an easier example. Just with most people, they're familiar with 401ks. And so when you have a 401k and you leave your employer, you can roll it into an IRA. In that transaction, there's no taxes on if you do it properly for that rollover, right? And the 1035 it's a similar thing to that. Is you're moving it from like to like, so you can avoid taxation at that time of transfer.
Very good. Okay. Now, premium finance. What is a premium finance policy? This one I should ask Brian, so that we're not picking on Brendan the whole time.
Yeah, so there's a number of variations. For us, the way that we really think about it is leveraged life insurance. And so from a high level, it would be, hey, I'm going to put in $50,000, and then a third party, typically a bank type situation, they would contribute a portion as well, right? So it could be A low end one can be like a 3-to-1 leverage. A high end one can be like a 10-to-1 leverage, right? And so there's a number of different variations, but generally we look at a 3-to-1 leverage to a 10-to-1 leverage on that side.
So, as an example, if it's a 3-to-1 leverage and I put in 25 grand, how much actually goes to the insurance company?
50.
3-to-1.
So if you put in 25, so like in the Kaizen situation, right? So you put in 25, they put in 25. So 50 totals going for premiums that year. You do that for 5 years, and then years 6 through 10, they're going to put in the full 50 for you.
That's one scenario.
Yeah.
So when we say 1 to 9, a lot of times, if I put in 100,000, the bank or some financial institution is going to put in, 8 or 900,000. So my overall premium is actually close to $1 million. And so, how do I get $1 million into a life insurance policy without using my own money? Well, you use other people's money. The OPM that everybody always talks about, you can do that with funding life insurance and provide a tax-free benefit. And then over the cash accumulation period of the policy, it's able to repay the bank. So essentially, you're able to use other people's money to grow a very large cash value asset that you can loan from in the future after it's fully funded and the debt is paid off. You can loan from this to do other things on a tax-free basis. So this is just another financial tool. There are certain eligibility requirements. Brian and Brandon were talking about types of this policy, premium finance, that are eligible even for the blue collar, white collar people who are not necessarily considered the highly affluent. Usually we are looking for a traditional premium finance policy, a net worth minimum of $5 million or greater, not including a primary residence. However, there are scenarios where the leverage isn't quite as high. There are scenarios where a premium finance policy can work for individuals below that net worth. Any other questions from the group? We've had a few, but we've been answering them as we go. Appreciate Elizabeth for sending out that question for clarification there.
Jake, question for you. So we have a client, they've had a cash balance plan for over 3 years. If we were to dissolve that, we would roll, this is my understanding, we can roll those assets. It'll be cut up by whose asset it is. And then we'll roll those assets into an IRA. What are the stipulations on restarting a cash balance plan for that same company?
So give me the scenario one more time. You had one.
So we have a client, they have a cash balance plan. They've had it for more than 3 years. It's my understanding we could dissolve the cash balance plan, roll it into an IRA, those assets. And then what if next year we wanted to restart a cash balance plan? Is there stipulations as to you can't restart a cash balance plan after a year, or what is the timeline? Once you cancel a cash balance plan, when can you restart it, or can you restart it?
You should be able to. It has to be a new plan with a new tax ID number, right?
Yeah.
You should be able to start one the very next year, as long as you didn't close it because of some regulatory, like you messed up.
Yeah. Okay.
So you can only have one company cash balance plan per company per year. However, if you close one in 2022, you can open one, to my knowledge, in 2023, as long as you didn't close it because of any regulatory issue.
Okay. Perfect.
Now, that's not as efficient as just keeping it going, right? Unless there's a desire and a need to change something, add different features or change provider, what have you. It's usually more expensive to close because there are fees to closing one. There's a final return and all this other stuff for the retirement plan. And then there's obviously the startup expenses of getting one going, which the cash balance is the least expensive of the defined benefit plan options in startup expenses.
Yeah.
But just being aware, there are expenses to close and expenses to open. If you can just keep it going and make adjustments to the current plan documents, that's usually the best way to go. Unless, of course, there are other reasons for closing it and starting a new one.
Yeah. Okay, cool.
Very good questions today. We have just 2 or 3 minutes left. Any questions before we go? Okay. Well, today we went over the restricted property trust because that was a request from meeting with clients this week. And so we covered that in great detail today. I'm more than willing to receive requests on what we discussed the following week. Next week, I have a guest speaker. His name is Aaron Bennett. He is a CFO, a remote CFO for a number of different businesses, probably like 80 or so different companies. And we will be discussing financial strategies from a CFO perspective. And so we'll have some fun dialogue going back and forth. And if you'd like us to discuss specific things that Aaron has seen based on strategies that myself or somebody else has helped his clients implement, we're more than willing to discuss that and have more of a panel discussion this following week.
Hey, Jake, what is kind of the number of employees does this stuff range from? Like, hey, I'm CFO for a single employee, just one owner, to like 500? Like, what's the range so we can kind of think of things to think through?
The range is exactly what you mentioned. I don't think he has a company of more than 500, but we can ask him. I do know that he has some, he provides CFO services for some companies that probably have more contractors than that.
Mhm.
But these are small, when I say small companies across the US, owner-only companies all the way over to companies that have a substantial number of employees, but not greater than 500.
Okay.
All right. Well, everybody, I am going to go ahead and end the call. I have my next meeting my next client trying to jump into the meeting. So we better say au revoir and see you next time.
All right. Have a good life, Jake.
All right. Talk to you later. Bye-bye.
Yeah.